Saw some game theory strengths.
All right, hey everyone, welcome back to Soccer Card Corner. This is Seth. Today I want to talk about sports card grading fees and specifically why we're seeing grading fees decrease and why I think they will continue to decrease. And we'll explore that through the framework of game theory to help us understand why grading companies would want to decrease prices of their cards and what we can expect moving forward. So, really quick, before we dive in, just a brief history in sports card grading fees. So I'm starting basically in late 2021. So as we all remember, during the pandemic, there was a sports card boom and grading fees, I think at PSA were like $12 for modern cards or $15 for modern cards, $12 for pre-modern, and basically PSA built up a huge backlog because everybody was grading everything, including base cards, and their whole system was flooded. So basically, PSA came back in late 2021 with a $50 per card economy and $100 per card regular service. These prices were primarily instituted to basically decrease the demand for graded cards, because at $50 a card, it didn't make sense to grade, just a random base Prism card. Whereas at $12 a card, and given the resale prices during the pandemic, during the peak of 2020, there was incentive for us, collectors, investors to be grading cards at those, most cards at those price points. At this time, SGC was also offering a $30 per card service with 1 month turnaround. So if we flash forward to June 2022, so PSA introduced a $30 per card service on par with SGC. This was really the first move by PSA to start decreasing prices. And this was a value service with a 20 card minimum and approximately 120-day turnaround, although we did see those turnarounds be quite faster than 120 days, I think most likely because the demand for that service wasn't as high as PSA expected it to be. At the time, SGC also continued to provide a $30 per card service with approximately 30-day turnaround, but again, we were seeing turnarounds closer to a week or two. In August, PSA decreased their prices again. They offered a $18 per card special for the National in July, and then they settled at $22 per card post-National for the bulk value service. SGC didn't change anything about their pricing at this time. And then most recently, the race to the bottom begins. We have PSA with a decrease to $18 per card, and most recently announced a $15 per card special for November. SGC in turn responded to the $18 per card price by PSA with basically a range of fees from $18 to $24 depending on how many cards you submit. So if you submit enough volume, you get an $18 per card price. If you only submit like 1 to 5 cards, you get a $24 per card price, and they are advertising 1 to 2 week turnarounds. BGS, just for sake of completeness, BGS and CGC are offering relatively similar prices and services. For purposes of this conversation, I'm really going to be focused on PSA versus non-PSA. So you can substitute, for non-PSA, you can substitute SGC, BGS, CGC. I kind of all have it lumped in the same bucket, but I'm using specifics from SGC for demonstration purposes. So again, where are we today? So PSA, $15 per card special with 128 turnaround for November. The normal bulk price right now is $18 per card. $30 per card for value pricing. That's basically if we have any declared values above $199, we can go up to $499 and get the same turnaround for $30 per card. SGC, as I mentioned, $18 to $24 per card. It varies on volume, 5 to 10 business day turnaround. And Beckett has a $22 per card service with subgrades or $18 per card without. So very similar to PSA and SGC, and they are advertising a 30 to 60 day turnaround. Okay, so it's prediction time. So I have a couple of predictions in terms of sports card grading fees that I'm going to make here. And I'll talk about why I'm making these predictions. But the first one is that I think grading fees will decrease further below even the current $15 per card level for PSA. And I think they'll stay there for the foreseeable future. Now, the foreseeable future could be a year, it could be 4 years. I mean, really until we see the next sports card boom. But I think that PSA is currently at the point right now where they're trying to figure out what is the market demand, and they're trying to understand at what grading fee will we increase demand so that we can basically utilize the excess capacity that PSA had built up during the pandemic. And then number two, I think in the next 12 months, at least one grading company will either go out of business, be acquired by another grading company, or both those things might happen. And to be clear, I'm not hoping that anybody goes out of business. I think competition, especially with grading fees, is excellent for the hobby. I just think that, and I'll get into this in more detail, I just think that the economics of grading fees in today's market are such that it will be tough to sustain healthy enough margins for a long enough period of time while also still keeping the grading card demand. If companies don't decrease prices, they'll probably lose market share to other companies who are willing to decrease prices. And the reason why I'm able to make these two predictions is because of game theory. So first, a very high level intro to game theory. You know, on this channel, I like to talk about economic principles. I try not to get too in the weeds, but I do want to give at least a little bit of background so you know what I'm talking about. So game theory is a behavioral economics study of the logical decision-making in humans and other rational agents. They've done studies with animals as well. And, games, I use games in quotation marks, can really be used to model almost any real world situation. So anytime you have, competitive forces or war adversaries, it could be sports teams, it could be an industry like sports card grading, for example, you can model what you expect, how you expect rational actors to act given different decisions, given different information, and given different payoffs associated with each of those decisions. So the simplest of these games are two-person normal form games. And this is where two parties act with given information and have associated payoffs for their combination of actions. So if I do X and you do Y, there's a payoff associated with that. A good example of this is, you may have heard of the prisoner's dilemma. It's basically just a simple game of, two parties have a choice, and based on their choices, they have payoffs associated with that. And based on those payoffs, we can basically reverse engineer what they are likely to do, assuming that they're acting rationally and in their own self-interest. So we assign payoffs to a set of outcomes. We understand how rational actors would behave given their set of choices. These games are usually reflected in 2x2 or 3x3 matrices, mostly for simplicity. There are obviously much more complex games that are out of the scope of this video today. So really quickly, before we dive into game theory, so I want to talk about John Nash really quickly. He is one of the foremost game theorists. He wrote his PhD dissertation on non-cooperative games, and he introduced a concept to game theory called the Nash equilibrium. And if you recall the movie A Beautiful Mind with Russell Crowe is John Nash in that movie. So the Nash equilibrium is basically where we assume complete information in these non-cooperative games. Therefore, we know how each player would act given the information of another, and we assume that all players understand the preferred strategies of the other players. Obviously, this is rarely the case in reality, but it's useful in helping us understand how people would react to known information. Basically, the Nash equilibrium says that no one has anything to gain by changing strategy. So given the information we know about the strategies of other players, we can model how each would act. And the Nash equilibrium exists when no player can increase his or her own expected payoff by changing strategy and assuming that the other player's strategies remain unchanged. Okay, let's talk about the prisoner's dilemma. So basically, the prisoner's dilemma is a common example in game theory of a simple two-person game where there's basically two criminals. They both commit a crime. They're both arrested. Each is in solitary confinement and cannot communicate with the other. So basically, they can't strategize on okay, we're both going to be quiet or we're both going to talk or whatever. So they each have two choices. They can either cooperate with the police and tell them everything they know, or they can not cooperate and remain silent. Cooperation would obviously mean betraying the other partner, whereas not cooperating means they would spend at least 1 year in jail. Depending on what the other partner does, there are different payoffs associated with each decision. So if one talks and they betray the other, and then the other person does not cooperate, then the betraying partner will go free, serve 0 time in jail, whereas the person who didn't cooperate or didn't confess will serve 10 years in jail. However, if they both confess, then they'll each serve 6 years in jail. So you can see payoffs over here in this table. If player 1 confesses and player 2 confesses, they both serve 6 years in jail. If player 1 confesses and player 2 does not confess, player 1 goes free and player 2 serves 10 years in jail. If player 1 does not confess and player 2 confesses, player 1 serves 10 years in jail and player 2 goes free. And then if they both don't confess, they would each serve 1 year in prison. So in a scenario where they could both coordinate their decisions and basically, choose what they want to do, the optimal outcome would likely be that they both just stay quiet and they both just serve 1 year in jail and then they go free. However, there's a risk here that if one of them act in their own self-interest and betray the other, well then by not confessing, you're basically facing 10 years in jail if your partner decides to confess. So, there's pretty wild payoffs here depending on what each person does. And so again, remember that we're assuming that all rational behavior is self-interested. In this scenario, people will betray each other for their own self-interest. So you can see here the optimal outcome for player 1 would be that he confesses and player 2 does not confess, right? So he goes free, player 2 takes all the fall. Conversely, for player 2 down here, that's the optimal outcome, is that player 2 confesses, betrays player 1 stays quiet, and player 1 does all the time. Because each prisoner gets a higher reward for betraying the other, that's why ultimately the most likely outcome is going to be that they both confess. Each prisoner gets a higher reward in any scenario by betraying the other, regardless of what the other one does. So if player 1 confesses, player 2 can either confess and get 6 years in prison or not confess and get 10. So obviously they're going to confess because 6 is less than 10. Similarly, if player 1 does not confess, player 2 can either also not confess and take 1 year in prison, or they could confess and get 0 years in prison. So here again, they're going to confess because that is in their self-interest based on player 1. So if you're player 2, you can basically say, well, if player 1 confesses, what's my best course of action? Well, it's to confess because I serve less time in prison. And if player 1 doesn't confess, what's my best course of action? Well, it's to confess because I serve less time in prison. And similarly for player 1, it's the same thing. So that's why the betrayal and confession is what's called the dominant strategy for each. And it's basically the only strategy where each person does worse by changing strategy. So because of that, both confessing is what is known as the Nash equilibrium. And so as an outside observer, we can basically say, okay, we know that given this set of information, each player would likely confess given, regardless of what the other player does. And we can model this through game theory, given the set of decisions and the associated payoffs. So let's talk about game theory and grading fees. So let's assume that we have a situation where there's PSA and then either SGC or non-PSA, whatever you want to substitute there. But they both can either lower their prices or maintain their current price structure. And we assume that lowering prices leads to more business if the other company maintains their current price structure. And in terms of lowering grading fees will increase demand for that grading service and therefore increase the amount of cards being graded through that grading service. We're also assuming that maintaining price can equal the loss of business if the other company lowers. So again, for the same reason, like if one company is lowering and the other is not, the company that's lowering is going to increase their market share. So what's the Nash equilibrium in this scenario? And just to go through some of the payoffs really quick, we're basically assuming that if PSA lowers prices and SGC does, they're both going to gain, but PSA will gain slightly more just because of the market dynamics, because there's already a high demand for PSA and they have built out significant capacity. If PSA lowers and SGC does not, then PSA will gain a huge chunk. So we have it labeled as 5, whereas SGC will lose some market share as -1. If PSA maintains prices and SGC lowers prices, we're just assuming that SGC will gain market share, but PSA will be relatively unaffected. And then if both maintain prices, we're assuming that's kind of the status quo, that PSA will kind of continue to gain market share just because they're the market leader and their current price points are such that I think are attractive to the broader sports card community. And these payoffs, you can assign, obviously in reality, these payoffs would be a little more complex and less simplistic, but this is just for demonstration purposes. So what's the Nash equilibrium here? Well, for SGC, the ideal strategy would be that PSA maintains prices and SGC lowers prices, because then SGC can gain market share and PSA is not. If PSA were to lower prices, SGC would obviously decide to lower prices, because again, they're getting a higher payout in either scenario than they would if they maintained. From PSA, their ideal outcome would be that they lower prices and SGC maintains, exactly for the same reason. And again here, if SGC lowers prices, PSA can either lower prices and get 3, or they can maintain and get 0, right? So they're obviously going to lower if SGC lowers. If SGC maintains prices, PSA can either lower prices and get a 5 payout, or they can maintain and get 1. So again, in either case, PSA is going to lower prices regardless of what SGC does. And so that's why this red circle here is the Nash equilibrium, because each party has incentive to lower prices regardless of what the other party does. And to explain it succinctly, by lowering prices, the grading companies will increase market share of existing cards that want to be graded, because people will be more incentivized to grade with the company that has a lower price than the company that has a higher price. So it's important to remember supply and demand here, and I know there's a lot of charts here, but let me just kind of walk through what I'm talking about here. So look at this first chart here. This is basically, demonstrates equilibrium price. So right here, when demand and supply are equal, that price right there, that's the equilibrium price and quantity. Okay, so when supply equals demand, when we have exactly the amount of supply as we do demand in the market, this price and quantity are what are known as the equilibrium price. During the pandemic, what happened here was PSA had a price here that was too low for the given demand. So you can see so on this demand curve for this price, there's not enough supply to serve this price. You can call this price like $12, right? Like this is where PSA was during the pandemic when they hit the backlog. So the only way to solve for a price that is too low relative to supply is you can either increase supply, which they did. They increased the number of graders and they increased their grading facilities, or you can increase price by moving up on the price along the demand curve until you hit supply equilibrium, which is also what they did. So this explains why during the pandemic, PSA not only increased the amount of grading facilities that they had, but they also increased prices up to $50 or $100 or whatever it was to basically decrease the demand. Like they could not supply the amount of demand that they had, so they had to basically increase the price in order to, kind of balance the supply and demand in the market. However, now you can think of where we are now as P1. So P1, we're at like $30, and then we were at $22, $18, right? But basically at some amount above the equilibrium price where we have the supply, there's enough supply to withstand the current demand. And so now what PSA and other grading companies are doing is they're starting to move this price down along the demand curve, looking for that equilibrium supply. And so that's basically what's happening here is we have grading prices that are too high relative to the supply and demand in the market. And these grading companies will continue to reduce their grading prices until they find that supply-demand equilibrium. And then this chart on the right here basically describes what has happened with sports card grading over the past 12 months. So initially, you can think of this original demand curve right here, and this original supply curve right here as, where we were originally. The new equilibrium price is going to be somewhere below where it was at the height of the market. And that's mostly because the supply has increased. PSA and other companies have increased their grading facilities. And the overall demand for grading is just not as high as it was during the peak of the market. And there's a number of factors that go into that, but you can think of people just aren't grading base cards as often. In general, the market is not quite as hot as it was just because of macroeconomic conditions. Like people just don't have as much extra money. So anytime you're basically increasing the supply of something, in this case, grading services, but then the demand for that thing is also simultaneously decreasing, you basically go from a price that's P1 up here to some price that's lower, P2. So that's also what's kind of happening on a more grading industry wide front, which is why, again, I think it's inevitable that the grading fees will decrease. So I hope that makes sense. I know it's a lot of charts, but if there's any questions on that, feel free to leave a comment. I'm happy to try and explain it a little bit better. Okay, so let's do another example. So now let's assume that both PSA and SGC, they lower their fees all the way down to like $12 a card. And we're getting closer to that demand and supply equilibrium that I just talked about. And so the payoffs here are different, you can see. They're slightly different than they were before. So there's a bit, but there's still more incentive for both companies to maintain prices than there was if prices were higher. But still, I would argue that rational behavior would suggest that companies will lower fees. And lowering fees is the Nash equilibrium. And at least with this set of payoffs, that's the case. And I'll show you why. So you would think, similar to the prisoner's dilemma, if PSA and SGC could basically like collude, which is obviously like illegal, but if they were able to collude, they would both say like, hey, let's maintain prices where they are, right? And we'll both sort of win. It's sort of like a win-win. However, given the market dynamics and the fact that we are not at a market where demand is super hot and we're still searching for that equilibrium between supply and demand, if PSA lowers prices, SGC or the non-PSA can either lower prices and get a one payoff, so like slight increase, or they can get a negative one. Basically, they lose a little bit of market share. If PSA maintains prices, SGC can lower prices and grab a bunch of market share, or they can also maintain and still grab more market share. But given that the way the payoffs are structured here, there's still more incentive for SGC to lower prices than there is for them to maintain. And the same is true for PSA. So ultimately, we get to the same conclusion where the most logical outcome is that both companies will lower prices. And now the caveat here is that they obviously can't lower prices to zero. Like, they're not going to lower them all the way down. So what I'm saying here is that companies will continue to lower prices until the market demand and supply equilibrium price is met. And the reason for that, and basically the reason for that is there's still basically market share to be had until the market is in that equilibrium. Now, obviously, one caveat is that, well, these companies are only going to do it if it's viable, right? Like, it's possible that SGC can't operate on margins of $12 grading fees. Like, maybe they need to have $18, $24 grading fees to make a profit for their business. That obviously comes into play here as well. There's obviously other, competitive forces too, where perhaps maybe PSA knows that, and it might be in PSA's best interest to even operate at a loss if it means putting competitive pressure on SGC or BGS or other potential upstart grading fees in the market. So I guess some takeaways here. If we can understand incentives for players in a non-cooperative game, we can model out expected behaviors. That's basically what I did with the two 2x2 games that I modeled out. Now, obviously, the payouts there, there's probably a bit more fidelity that we could put around that. Given information, we could probably better model out those payouts. And we're obviously not going to have complete information, but it's at least a simplified way to understand how different, participants in a market will act. And, funny enough, I actually started this presentation a couple of weeks ago where I was going to predict that I think PSA is going to decrease their prices again. This is when they were at 18, and then they came out with this $15 bulk special for November. So I decided, I really need to get this out. But basically, it's playing out how I initially thought it would play out, where even at $18, PSA had some room to maneuver, and they're either going to get a bunch of market share, which I think is what everyone's waiting for, is for PSA to decrease their price point anyways, or they're going to apply extreme competitive pressure on other grading companies to either follow suit, or if SGC decides, hey, we're not going to decrease to $15, well, then it's kind of a no-brainer to grade with PSA for $15 than it is for SGC, unless you absolutely have a card that you need back for some reason in a week or two, right? So we can basically apply this model repeatedly over time. And basically what will happen is like as we update for new information, the payoffs will change. And eventually the payoffs might dictate a different Nash equilibrium or a different outcome to the game. But by doing so, we can understand, you know, how we would expect different parties to act given the different payoffs, given the different market dynamics. And so basically grading companies are going to continue to have an incentive to reduce grading fees. And again, this assumes that the market supply and demand is not yet in equilibrium. And relatedly, that the companies themselves have the supply to meet this market demand at a lower price point. So not only do they have the grading capacity, but they also have the business model, or they have the, you know, cash on hand and runway to operate at, you know, lower margins. Because if they're, you know, grading for 18 versus 24 versus 30, obviously they're making less money per card that they grade. So again, I mentioned, but PSA has added incentive to lower prices if it would apply competitive pressure on competitors or make them attractive acquisition targets. And that's kind of where my prediction of either a company going out of business or being acquired comes into play, is because I think PSA, as they, you know, now that they've built out their excess capacity, they're going to have much more incentive to continue to really turn the screws on grading fees and really see where they can, you know, kind of squeeze their competitors. And, you know, as they basically, like, as they keep decreasing grading fees and as SGC and other companies keep following suit, that sort of suggests that we're not quite at that market equilibrium yet. So again, I would expect grading fees to continue to decrease, albeit, you know, probably by smaller increments, until we start to see basically the overall grading volume react. You know, like we would expect grading volume to go up as grading fees go down, and that can only go up, you know, for so long until we have backlogs and things like that. And one really good resource I would actually point you all to as far as like grading volumes is, so GemRate has a monthly newsletter that actually shows, you know, how many cards were graded by each grading company, what sport, what era. It's actually really cool. Would definitely check out GemRate and subscribe to the newsletter if you're interested in that type of stuff. And so, you know, the last thing I'll say too is that I'm just not sure how much lower SGC, BGS, etc. can go in terms of prices before their business models become unsustainable. You know, I know SGC has really quick turnarounds. I think part of the reason for that is that they might just not have the volume of cards being graded that other companies like PSA does, and that bears out in the in these GemRate monthly reports as well. And finally, looking ahead, and here I put a table from the GemRate blog that I just referenced. But basically, I think PSA can continue to drop prices, assuming they have the capacity, and that'll fend off strategic price drops from competitors. So basically, if PSA is always one step ahead of SGC or BGS or CGC, or CSG, you know, it's going to be hard for those companies to really gain market share on PSA. In addition, PSA is already grading more than 1 million cards per month. So this is for October. PSA is grading 1 million cards. CSG has 135K, most of those being CGC trading cards. SGC is at about 81K, and Beckett's only at 52K. And you can see SGC and CGC have actually increased the number of cards that they've graded over the last month. And I think that is in part due to, that it is in part why PSA has dropped their price, because you can see PSA's graded cards decreased by 3% month over month. Clearly they have the capacity because they graded more cards last month than they did in October. So they're decreasing prices accordingly to try and gain more of that market share from SGC and CSG. So other grading companies will basically have to follow suit, or like I said, give up market share. And the question here becomes, like, can they sustain? Like, if PSA is down at 15, like, can SGC go to 15 and still sustain their lower margins? If PSA goes to 12, can SGC go to 12 and have any chance of sustaining its current, you know, margins? That's kind of the $1 million question. I do think that there's potential for SGC or BGS or, you know, CSG. CSG kind of already does this with their CGC trading cards, but basically I think some of these companies could position themselves as like the market leader for a certain type of card. So I think SGC, for example, vintage soccer, vintage baseball, like they could become like hey, we are the market leader for vintage baseball. And actually in this blog that I referenced, the GemRate blog, it goes into like what are the like the most graded sets per grader, and SGC is like the most graded, like their most graded sets. Some of them are like 1959 tops, 1960 tops, 1961 tops baseball. And so they're already kind of establishing themselves as that vintage leader. This is kind of similar to how BGS does subgrades. Like they're really the only major company that does subgrades. And so you can either pay $18 to BGS for no subgrades, or you can pay $22 with subgrades. And that's sort of like a differentiator of, or like maybe a reason why somebody would go to BGS versus another company. I also think that non-PSA companies could proactively lower prices to gain market share. So like instead of waiting for PSA to drop prices, maybe SGC just says like, yo, we're going to grade for $12 a card, right? That's certainly possible. And I certainly think that that would help with their overall market share. But again, it comes back to the margins. Like, can they sustain that? I don't know. I mean, that's information I don't have. My presumption would be that PSA is probably best positioned to sustain lower margins just because they're, you know, the most established, the largest, they have the highest resale value. Like they just have enough going for them, but it's just hard to say. But ultimately, I do expect grading fees to fall until that demand supply equilibrium is met, and I don't think we're there yet. PSA is still obviously the clear leader in name and resale value and presumably operational capacity. If they were to hit some sort of backlog again, that would obviously help competitors as it did during, you know, the height of the sports card boom. I just don't know that I think PSA is a bit more equipped to handle the market demand. And as you can see by the way that they've introduced pricing and slowly dropped it, I think they're being a bit more strategic about understanding, you know, this supply demand equilibrium issue. So like they start at 30, they drop to 22, they drop to 18. Now they're testing out 15. I think we're getting to the point where like we'll get to that equilibrium, but PSA is not just going to go from 30 to 12 overnight. I think they're being much more strategic about it, which I think makes sense, but also leads me to believe that I don't think that they're going to hit a backlog or capacity issues anytime soon. So that'll do it for today. Would love to know what you think about this. I know it's a bit more theoretical and, you know, economic philosophy theory type video, but I really like this stuff. I think this stuff has huge implications for all sorts of market dynamics, but it's, you know, with grading fees, I just kind of saw it happening. And then of course, like I said, before I could even get this video out, PSA dropped their grading fees again. So yeah, it'll be interesting to monitor. And I do think that ultimately it's good and the competition is good for us as market participants, but I do think that we're not quite at the end of the, you know, I don't quite think we're at the bottom in terms of sports card grading fees. So let me know what you thought. Would love to hear your comments and your thoughts. And thanks again for tuning in. I'll talk to you guys soon. Bye.